What goes up must come down. Newton's third law of thermodynamics was clearly on show today as the spectacular large cap rally that has bewildered the bears came to a screeching halt. The S&P 500 snapped its longest streak without a 2% decline since 2007, coupled with ugly market breadth meant stocks of all shapes and sizes sold off. And if it isn't clearly obvious, the price action we're seeing looks awfully reminiscent of a market top. And with uncertainty looming and valuations extremely frothy, it's clear the market wants none of it. Alphabet grew its earnings last quarter 28% and the stock was down 5% today, as proof that tech stocks have simply run too far too quickly. So the big question we're going to tackle today, is this the market top? We're going to dive into the data, the stats, as well as seasonality to determine just how bad things will get and what normally comes next. So should you sell, hedge, or maybe buy some more? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a ton of red in the big names. That meant the S&P 500 went lower, the Nasdaq 100 went lower, and it was again led by semiconductors, but a lot of broad-based participation in the selling here today. Not just the magnificent 7 names, but financials too, credit services, banks, asset management, industrials, selling across the board, cyclicals, the discretionary space, even the real estate sector after the weaker than expected home sales data. But we did see green in certain sectors, and it is a little concerning, and we do need to talk about it. Excluding what we saw from the earnings space, and we are going to talk about some upbeat action in stuff like software as well as the discretionary space, we did see a clear rotation during the day's trade here in telecom services, healthcare, very green, utilities, energy, and staples. And it's very clear what the market was doing today. We were just going into stocks that display defensive characteristics. Look at utilities, healthcare, consumer staples, energy, and yes, even though staples wasn't green today, it was flat. And then look at the next stock below staples, financials, the 5th best performing sector here today, down 1.2%, technology down 4.1%. This is just valuation concerns. Guys, look at communication services, right? Google was down 5.6% today after reporting 28% earnings per share growth. They beat on the top line, beat on the bottom line, beat in every single one of their business segments except YouTube, which missed on an effects neutral basis. They only missed because of a weaker dollar. That's it. And communication services was down 2.6% today. Absolutely crazy price action here, and this has to just do with valuation. We're seeing stocks with high valuation get sold off. That's bringing the entire market down with it in stuff like materials, financials, real estate, industrials, and we are seeing a bit of a rotation into the value components of the market. Stuff like utilities, stuff like staples, stuff like healthcare, and also stocks that display defensive characteristics. And even across the size factor segment, small was down today, mids were down today, large caps were down today. Although mid caps were actually the best performing stocks right here, we did see mild outperformance in value relative to growth across smalls, mid, large. We also saw the best was actually large value, and this is because the market was rotating into large staples, large healthcare stocks, large utility stocks. In terms of the broader market, when it comes to defensive stocks, large value is really the ones with defensive characteristics. No one wants to go invest in a small utility company. No, that's way too cyclical in nature. If you're going to get defensive, it's going to be in the large names, and this is exactly what we saw. And there wasn't much supporting stocks here today. What we continue to see is just this liquidation out of financial assets. We saw Bitcoin coming under pressure, down 0.32% today, down 2.4% yesterday. Gold coming off its highs, strong sell-off from a peak to trough basis here today, although only down 0.46%. Silver at the 28 level, down 1% here today. The only commodity that was in the green was crude here today after a gap up 0.82%. A lot of bears did come in at the top here, although still within our overall range. Another interesting development, look at the 2-year yield. The 2-year yield was actually down 1.29%. The 10-year yield actually gained. So we're starting to see the yield curve uninvert. What we really want to see is this number right here, the 4.2, be above the 4.4. So the 10-year yield needs to be bigger than the 2-year yield. Right now, the yield curve is still inverted in the 2s and 10s. The 30-year bond and the 2-year bond, the yield curve is uninverted. The yield curve is actually normal. It's what you would typically see, but we're still waiting for the 10s and 2s to uninvert. And here's the spread between the 10-year and 2-year yield. You can see we're about 14 basis points from the yield curve uninverting. Below this line, the yield curve is inverted. Above it, the yield curve is normal. Once we get above here, then we'll see the 2, 10s, and 30s with a normalized yield curve, although the big issue is still the 3-month, but that'll come down when the Fed cuts rates, because the 3-month is highly tied to the actual Fed funds. But looking at the S&P 500, we saw very ugly action. This is very, very ugly action. This purple line right here, that's the gamma flip zone. We were above it at the close of yesterday. We gapped below it and continued the sell. That's a very, very ugly candle in the S&P 500. And we saw selling, guys, across the board. The Nasdaq down 3.65%. The IWM down 2.5%. But on a technical basis, looking far stronger than something like the S&P 500. The RSP down 1.17%. So we did see the equal weight, small caps, mid caps, which are down 1.97%. These smaller factors did outperform the larger factors. And then the SP 600 down 1.86%. In what was a brutal day of market volatility. It was just a liquidation. It was people getting jittery about election concerns. We did get some bad data today. The longer end duration of the curve, the 30 and 10-year, is rising. That is going to affect larger names more than it is going to affect smaller names. And now that we are officially in negative gamma in the window of weakness, that means dealers don't hedge on the side of the bulls. They hedge with the bears. In other words, if the market is going down, dealers are selling into the weakness, and if the market's going up, they're buying into the strength. That's what we get in negative gamma. And what we normally see is that we sell off to the put support zone. And right now in the S&P 500, that's at this level right here. On a technical level, this makes sense because it's where we saw some volatility right here, and it's where we actually started the sell-off here in April. So if we do pull back to this 5,300 area, it's where the put support is, but it's also where there's a ton of confluence. And I think if we do get to this level, we could pull back to as far as the 5250 level, the bottom end of this rectangle. And that would actually mean if we do come all the way down here, find support in this area, that would be a higher low, and then we can attack new all-time highs. It does get a bit grim if we break the put support on the way down here at the 5,300 area, and then we actually break below this area right here. That would open up some of the lower levels we've seen below the 5,000 area. And right now that means we look to the 5,300 area as our first support zone. We may have a little bit of a bounce maybe here tomorrow because this was vicious selling, but I do think that as long as we are in negative gamma, we can actually sell to the put support. That's generally what happens. We also are in a seasonally weak period of the year from the end of July into as late as October. We generally do see selling. Seasonality looks something like this, where we trade sideways to down all the way into October. This is October. This is the start of August. And then we actually go ahead and break those highs. So we are in a seasonally weak period of the year, coupled with all of the uncertainty we're seeing in the market that is leading to downside. But as long as earnings hold up, which they have, this is all just a dip, a buyable dip opportunity, because I do think we're going to go higher into the end of the year, into 2025. And in positive gamma, guys, we do one thing, and that's we buy dips, sell rips, look to the call resistance. In negative gamma, we actually don't take the sell side. What we do is we sit out the volatility, we wait, we build cash, and in the stocks we like, in the ETFs we like, we buy at key levels. The first key level would obviously be this 5,300 area. I mean, if you're loading up right here, that wouldn't be a bad idea as well. But 5,300 area would be the first key level. Then maybe again here at the 5,200. And then if we do get there, the 5,000 level those would be the key levels where I would load up on as we prepare ourselves for the rally that's going to come at the end of 2024, 2025. And we had a bunch of earnings reports here after the bell. We had stuff like Chipotle, Ford, ServiceNow, IBM, KLA Corp on the semiconductor side. Now, I want to speak about KLA because they were up 3%. They're one of the largest equipment manufacturers. To see them report the earnings they did, very good results. ServiceNow trying to save software. They were up 5.13% here in the after hours. Ford, however, was down like 11%. Pretty rough go of it. And we're going to dive a bit deeper into Chipotle. Absolutely crazy. If you know the run that this stock has gone on in the last 2 to 5 years, absolutely insane. And they actually reported a double beat on both the top line and EPS. 34 cents in EPS against the street's expectation of 32 on sales of 3 billion against 2.94, and that's an 18% increase year over year. Now you may be asking yourself, yes, this was great revenue, but so much is priced in. The stock trades at like 100 times earnings, right? The big thing that really helped the stock was, number one, they opened 52 new restaurants, but one international licensed restaurant. And so this company is only just beginning to expand internationally, and that's a huge opportunity for them because as it is right now, their only geography is pretty much only the US. So to see international expansion just means they have such a long runway of growth, which is already stellar at the moment. Also, we saw operating margin expansion. I think operating margin went from something like 19% from 17%, right? So when you see operating margin expand and then you also do another 400 million of buybacks, you're going to get a move you saw here up 8.63% in the after hours. I still think it's overvalued personally, but a stock like this, the market can remain irrational longer than you can stay sober. So great earnings here from Chipotle. You can't fault them. Shout out to Bill Ackman for buying this in 2016. Now, looking at a measure of sentiment, this is a survey that Bloomberg did. They asked, will this earnings season give the S&P 500 a boost or push the S&P 500 down? Very interesting. 60% of participants said this earnings season will give the S&P 500 a boost. The remainder said it will push the S&P 500 down. And I wonder if these individuals actually know how the market works. I would like to know who Bloomberg is actually surveying, because markets are not present day looking, they're forward looking. And for earnings to give the S&P 500 a boost, we would have to have a beat in a very big way. And that is kind of the case as it is right now. S&P 500 earnings surprise factor is at 5.2%. However, when you dive deeper under the hood, you see some very positive developments. Every single sector, excluding utilities, but they haven't had any companies report earnings yet, is actually reporting earnings surprise, with the best sector being the discretionary space up 11.1%, the worst being energy with a 1% surprise to the upside. And essentially what this means is, let's assume earnings is supposed to come in at 10%, that's analyst expectations. With the 5.2% surprise, earnings are coming in at 10.52%. That is what this number means right here. So positive developments across the board, and this actually includes Tesla's earnings miss. So to see discretionary with a 11.1% earnings surprise is actually kind of crazy, all things considered, and knowing what Tesla's weight is in the discretionary space. But things are looking rather positive, but enough to give the S&P 500 a boost? I don't really know. Maybe not in the near term, but over the next 3 to 6 months, sure. I think this quarter is going to be very pivotal for the rest of 2024. Now, what exactly are corporates doing with their earnings? Well, they're putting it into buybacks. We can see that buybacks as a percentage of S&P 500 market cap is nearing 2019 highs, where we are right here. I do think that by the end of this year or at the start of next year, we probably will eclipse this number right here and see buybacks very similar to what we saw in 2019. And this is part of the reason why we're seeing some weakness in large caps. Plenty of companies are entering their blackout buyback period in the next 1 to 2 weeks if they are not in it already. And that buy side support via buybacks is simply not there for the large caps. And part of the reason why large cap stocks do so well is simply buybacks. If we actually just look at fund flows last week from both his clients, you could see that last week and in the last 4 weeks, the biggest buyers of equities have actually been corporate clients. This right here is literally just big corporations buying back their own stock. Very interesting to see that hedge funds and institutions, both in the last 4 weeks and last week, have actually been net sellers of equities. And if you do have a look at some of the bigger names, stuff like the Magnificent Seven, you look at a name like Nvidia, the price action we see there is reminiscent of a top. So it does look like hedge funds and institutions are hedging their bets, retail, equity neutral, and corporates just buying back the stock because they're obliged to. But in total, we've seen net equity inflows in the last 4 weeks, but net equity outflows in the last week. And we're going to keep track of this to see how it evolves over the next coming weeks and months ahead. And maybe hedge funds and institutions are looking at stuff like seasonality, potential valuations, and saying, hey, maybe I want to sit out right now, go to cash, maybe get short, but they clearly are positioning themselves for downside momentum in the coming weeks. Over the last couple of days, we've looked at these 3 studies, and it pretty much tells us what the S&P 500 does when we've had a trailing quarter that's positive and when we've had a positive May to July or a negative May to July. Now we've looked at these 2 over the last couple of days. Now we're going to view what happens to August when we've had a negative May to July. Now on average, we see returns of 0.9%, 20 up years, 8 down years. This is actually in contrast to when we've had a positive May to July. We have had that in 2024. May to July so far has been up 9.52%. August normally comes in negative 0.57% on average, negative 0.65% median, 20 up years, 26 down years. So August tends to be that counter trend month where if you've had a positive year, you tend to get a negative August. And if you've had a negative year, you tend to have a positive August. However, that is not necessarily the case in an election year. In fact, August tends to be the best month in an election year, up 3.09%, 70.8% hit rate. The only negative months we do see in an election year after August is September right here and October, which are slightly negative, and they have pretty poor hit rates as well. But we want to remain constructively bullish for what is an amazing end of year run into November and December, up 1.14, 1.51 respectively. And look at December's hit rate, 83.3% of the time it is positive. Absolutely wild. So essentially what all of this data is telling us, we should expect an end of year run. However, we can see near-term volatility, which could potentially start in August, but it's more likely to materialize here in the September-October period. But this is all just a dip buying opportunity because November, December, the Santa Claus rally tends to be very, very positive. And looking at the election year seasonal pattern versus 2024 year to date, we can actually see that during the election year, after August, what we normally do see is pretty flat to down returns, and after that we actually make a higher low and then go ahead and actually break these highs we made here in August, September. And in the case of the S&P 500, that would be us making new all-time highs. Now, you don't actually want to look at the level, you want to look at the trend. So this doesn't mean that we're actually going to mean revert. It probably means that we're going to trade somewhat sideways here in the S&P 500, probably put in a bottom, break this low, and then go from there to make new all-time highs in the S&P 500. Now, this isn't a crystal ball. This just allows us to assess probabilities for what might happen. We could just rally from here. We could actually break down and sell off 20%. We could 100% do that. However, the more likely outcome is that we trade sideways to down over the next 2 to 3 months, form a bottom, and then go from here. And as long as earnings holds up, and as long as the macro holds up, we should see the S&P 500 break these highs into the end of 2024 and make even higher highs in 2025. Now we get a big GDP print tomorrow. We're getting second quarter GDP and expectations are wild. Consensus is 1.9%. Bofa think 2.5%. Goldman think 2.3%. But in aggregate, the GDP figure is looking like it's going to come in strong. And part of the reason why I didn't pay too much attention to the weak Q1 print, which was 1.4%, was simply because final domestic demand remained very, very strong. Final domestic demand is simply a measure of spending, specifically the sum of financial consumption, investment, and stock building expenditures by both private and government sectors. It remained very strong here in the first quarter at 2.2%. And that'll probably be the same into the second quarter. And we did see the first quarter's flow on expenditure flow into GDP, especially here at the start. GDP was tracking at above the 4% mark and still looking reasonably strong here at 2.7% according to the Fed's GDP now. The reason why I've been paying close attention to this figure this week is because I want to see where this ends up and where the actual reported GDP figure comes in, just to see how accurate the Fed's GDP is right now. Currently tracking at 2.6, maybe 2.7%, but we will see where the cards land. Another data point that's been incredibly strong is US federal employment tax receipts. This is something I've been looking at lately, and we could see this is where 24 starts. So everything below this line is 2024. Now, January tax receipts was 1.4%. And we had a strong February 6.1%, March 7.3%, 4.3% here in April, 8.1% in May, 5.6% in June. This is year over year growth, by the way. And so far, July is tracking up 4.6%. The daily average being 3.9%, but this actually includes all the way up to August 2023. If you actually just look at 2024, this number is sitting at very close to 4.8%. Very, very strong in federal tax receipts. This number is highly correlated to GDP, and all of this is just a strong indicator of economic growth, employment, corporate profits, investment returns, fiscal health, and consumer spending, which we know is actually quite robust despite what the market, the news, and Twitter will tell you. Retail sales simply do not suggest the consumer is pulling back. In fact, the data tells us consumer spending is actually rather strong. And strong consumer spending often leads to strong growth simply because US GDP is 67% consumption based, and when people have jobs and the consumer is strong, growth will continue on trend. GDP is highly correlated to earnings, and in an environment where earnings are growing, you want to hold equities. Now, for the rest of the week, we have a big week of data. I just want to go over some of the key data points we have. Tomorrow we have durable goods. Now we're going to look at BOFA's estimates. Durable goods orders to come in at 0.6%, ex-transport 0.2%, core capital goods shipments 0.2%, and core capital goods orders 0.1. So if this is what inline figures would look like, then the obvious one that's going to move the market is to GDP print. Both is expecting 2.3%. Consensus is 1.8. I've seen some figures of 1.9. Goldman's actually expecting 2.3, so we'll see how that goes. Then GDP price index of 2.6%. That's both his estimate and the consensus. And then core PCE seasonally adjusted 2.8%. And then on Friday, we have PCE, and we'll tackle the consensus and BOFA's estimates tomorrow, along with the savings rate, spending rate, and then Michigan sentiment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.